Hello and welcome to this session on pensions for business owners. My name's Owen and I work in the financial wellbeing team within Hargreaves Lansdown. And during the course of the next 20 minutes or so, we'll be discussing some of the elements of pensions, personal pensions, and how they may well assist people who have their own businesses. So none of the information that I'll be giving should be construed of as financial advice. Really, it's just trying to put you in the best position possible when you're trying to decide how to make provisions for your future. If you feel that you do need specific advice, then that is a separate service offered by Hargreaves Lansdown. So do get in touch with our help desk to find out more. So the presentation itself will be going into various examples of how pensions work and how tax relief works. So undoubtedly they're not going to apply to everybody and everybody's circumstances. But really it's just designed to give you a bit more understanding of how a pension can help get you to the point at which you possibly want to retire and generate that income in retirement that you think you may need to sustain your lifestyle in the future. So retirement is a funny one. Everybody is different in terms of what it is they want to be doing in retirement, and not everybody will look to have the same retirement. So there's quite a few studies that have been done into retirement and levels of income that on average people will need to live certain kinds of lifestyle. And also looking at the kinds of pension pots that on average people have at various points throughout their lives. So it's the case that a couple of years ago, 16% of self-employed people are contributing into a private pension. In the late 1990s, that was more like 48%. So we've seen a big drop in the amount of self-employed people that are actually contributing towards a pension for their future. On average, private pension values tend to be at their highest at some point in people's late 60s, early 70s. Around about £206,000 is sort of fairly average personal pension pot at that point. And it's estimated that in order to live a moderate standard of lifestyle in retirement, if you're in a couple, you'd need just over £29,000 a year. And we'll go into a bit more detail on what moderate means and other kinds of lifestyle that people may want in retirement, and the kinds of income that it's thought that people should be trying to secure. So where's your income going to come from when you are retired? The first source of income for many people will be the state pension. And the state pension is what you receive for paying national insurance contributions throughout the course of your working life. And in order to receive the full state pension, you need to have paid national insurance contributions for 35 years across your life. And if you do that, then the amount you'll receive from the state will be £9,340 a year in today's terms. So that's the state pension as it is for the current tax year, although things are subject to change. However, the age at which that state pension kicks in has recently gone through a process of increasing. And it did used to be the case that the state pension kicked in at 60 for women and 65 for men. However, they've equalised the women's state pension age in line with men at 65, and then over the last few years have been pushing that up to 66, and then it's moving up again to 67. And then for anybody born after April 1978, state pension age is due to rise further up to 68. So whilst just over £9,000 a year isn't a bad amount of money in itself, it will probably go a long way to covering most people's basic bills and living costs. If it's not going to kick in until your late 60s, many people will have wanted to have had some form of retirement, a reduction in working hours or full retirement potentially before that state pension age. So it is really important to have your own pension provisions to give you a bit of flexibility about, firstly, when you retire, but then also the kind of lifestyle that you will lead in retirement. So a pension works in a way that you pay money into it, and money that you pay in benefits from tax relief or a tax saving. So that's the government's incentive to get people saving for the future, is that they give you the tax back on money that's paid into a pension, subject to certain limits. And then once that money is in your pension pot, you can choose how that gets invested. And the investment side of things is really important. It may not be something that people have necessarily considered before, but trying to get the best investment growth you possibly can is really important, because those two things together, how much you pay in and how well your investment performs, they combine to build that pot of money up. And it's that pot of money which will then sustain you, hopefully, in retirement. The earliest point that you can access that pot is from 55 onwards, although that is being linked to the state pension age. So 10 years before state pension age is the earliest point you'll be able to access the money in the future. So we'll go up to 57 and ultimately 58 as state pension age rises on an ongoing basis. Whatever you've built up in your pots, you can withdraw 25% of that as a lump sum tax-free, and then the balance is yours to generate your pension income. So the bigger the pots, bigger the lump sum you'll have, and the bigger the income in retirement. So I've already mentioned a couple trying to live a moderate standard of lifestyle in retirement would need an income of about £29,000 a year between them. This is based on information and research done by the Pension and Lifetime Savings Association the year before last, when they looked into retirement and tried to come up with some of the more standard costs and outgoings that people would incur, and then look at some of the slightly more luxury things that people might like to do. And they then categorized retirement into three different areas: the minimum standard of lifestyle, a moderate standard of lifestyle, and a comfortable standard of lifestyle. So in order to achieve a minimum standard of lifestyle, if you're an individual in retirement, you need an income of just over £10,000 a year, or between two in a couple, £15,700 a year. So for people in that situation, the state pension is likely to go most of the way to making up your income, and really, as the name suggests, that is the minimum required to pay your bills, shopping, and get by really in retirement. The moderate standard of lifestyle, which we assume most people are probably trying to target, requires an individual to have an income just over £20,000 a year, and again a couple an income of £29,000 a year. So the state pension will again go some way to covering that, but that does then leave a bit of a gap for individuals to try and save a bit more themselves into personal pensions to try and top that amount up. And the moderate standard of lifestyle would give you the ability to go abroad for 2 weeks each year, eat out once or twice a month. So you'd still be able to do some of the slightly more interesting things that you might have done whilst you're working, and as well as paying your bills. The really comfortable standard of lifestyle would require an individual to have about £33,000 a year as a retirement income, and between two in a couple, £47,500 a year. And this would then be for somebody who's looking to renew their car every couple of years, spend a longer period of time on holiday, potentially abroad, have a more expensive weekly food shop. Some of those things which aren't a necessity as such, but may be things that you have depending on your personal preferences. So in order to retire then in London, so if it were the case that you lived in London and had worked your life in London and wanted to retire there, then it's likely that you would actually need slightly more due to things being slightly more expensive. These figures normally assume that you've got somewhere to live that you don't then have to pay for in retirement. So often people's costs do dip when they come to retire, but it's still a good idea to have a really good level of income, or the best level of income that you possibly can. So for somebody who were looking to build up that moderate standard of income in retirement, we then worked back, and it suggested that in order to get a pot big enough to give you the moderate standard of lifestyle in retirement, you'd need to contribute about 12% a year of your salary over a 50-year period. So starting work at 18 and finishing work at 68, so a really long period of time. Many people possibly won't be working that long or won't want to work that long. So for every 3 years less that you don't want to work, or you haven't worked, you need to contribute an extra % into your pension. So if you only wanted to work for 42 years, which is possibly a bit more average, then you need to contribute around 15% of your salary into your pension. So that gives you an idea of the kind of contribution required over a long period of time to build up a pension pot capable of giving you a good level of income in retirement. So how do those contributions get made? For people with their own business, it will depend on how you're set up. If you're a sole trader, then you're contributing, any contributions you make individually are net, so it's via relief at source. and I'll explain a bit more that term in a moment. But really what it means is when you put money into the pension, it then benefits from tax relief at whatever your marginal rate of income tax is. If you're a director of your own company, then you can make contributions from your salary that you're paid by the company, and that can be done via salary sacrifice, saving tax and national insurance. But you can also pay contributions in from the company directly, which then the tax benefit is for the company and may save corporation tax. So it depends how you set up as a business, but there are ways of getting money into the pension that are tax efficient. So the relief at source method, which I mentioned firstly for sole traders, you would have been paid your income, whatever it is, which has had tax and national insurance taken from it. You could then pay that into a pension pot, and at the point you do that, the pension provider will claim basic rate tax relief on your behalf. If you're a higher or additional rate taxpayer, you then have to claim any higher or additional rate tax back from HMRC, typically done via a self-assessment tax form. But if you don't do one of those, then you can write to HMRC and notify them that you've made a pension contribution. When contributions are made via salary sacrifice, or salary exchange is the other term, simply the money is deducted by the company rather than being paid to you. And as a result, it doesn't have any tax or individual tax or national insurance taken from it. You can then pay that money into the pension. So there's nothing further for you to reclaim because it's not had any tax taken from it in the first place. And crucially, the national insurance saving is also made as well. Because of those generous tax benefits, the fact that you can receive tax relief at whatever your marginal rate of income tax is, and then potentially national insurance as well, there are limits on how much you can pay into the pension and benefit from tax savings on. So you can't pay in more than you earn across the course of a tax year, and that's then subject to an annual allowance, which is £40,000 for the majority of people. If you're classed as a high earner by the government, so if you have adjusted income in excess of £210,000 or more, £240,000 or more, then the amount you can pay into the pension starts to reduce. So do let us know if that's the case. You can then also look at previous tax years and carry forward unused allowances into the current tax year to enable you to make a higher level of contribution. And pension pots that you build up are then subject to a lifetime allowance of £1,073,100, which is the total figure that you can build up in your pensions. Anything over that, you then start to pay a punitive rate of tax when you come to draw it out. So these figures are subject to change, so they're all appropriate for the current tax year, but do keep an eye on the budget in future years to see if any changes get made to how much you can pay into your pension. So the kind of pension that is available through Hargreaves Lansdown is known as a SIP, or self-invested personal pension. And again, this allows you to make contributions into it and receive tax relief at whatever your marginal rate of tax is. And we're a really big, well-established company with a long record of providing personal pensions. With a help desk on hand to assist in making decisions, be that how much you're paying in, how it works, how you then decide for the money to be invested. We don't provide specific advice, so it is still then up to you to make a decision. And whilst the help desk and various sources of information on the website will give you loads of detail, it's still then up to you to decide what it is you actually want to do. But there is a lot of assistance from us regarding selecting investments. So even if you haven't previously been involved in that side of things with pensions before, please don't let it put you off and think that it might not be for you, because there is so much assistance available. So when that money goes into the pension pot, getting the best level of investment growth you possibly can is key, and it sounds quite straightforward, but the higher level of growth you receive will result in you having a bigger pot in the future. So in this slide, somebody starting off with £30,000 in their pot, if they invested that for 30 years and it grew at 1% each year, they'd have just over £40,000 in 30 years' time. If they grew at 4% each year, they'd have just over £97,000, and growing at 7% each year, they'd have £228,000. So just a couple of percent better growth each year, compounded over a really long period of time, gives a much bigger pension pot. But in order to achieve growth rates at those higher levels, you may find yourself needing to consider investments which have a higher level of risk associated with them. And risk is really the chance of that money fluctuating in value for the period of time it's invested for. So different investments perform in very different ways, and this line shows how cash has performed over the last 25 years. So cash is seen as a relatively secure way of investing your money. It doesn't dip in value, but when held for a long period of time, cash may not keep pace with inflation, and inflation being the rise in the cost of everyday goods and services. And that's certainly what we've seen over the last 25 years. Somebody who put cash in the bank 25 years ago, if they took it out today and tried to buy the same amount of things they were able to 25 years ago, they wouldn't be able to. So prices have gone up quicker than interest rates on cash. This line shows how gilts have performed, and gilts are loans to the UK government. So by lending your money to the government, you're taking on a bit more risk than holding it in cash, but they are traded investments and they go up and down in value. The UK government is seen as quite a secure borrower, so it's still not necessarily seen as a highly risky investment, but there is more risk associated with cash, and as a result, you would hope the return over the long term would be higher. And this line illustrates an investment into the UK stock market, or shares. And shares over that long period of time have comfortably outperformed the other kinds of assets. But you'll notice that they're characterized by big dips along the way, most noticeably this time last year, where the global lockdown started, and there was a big dip in the value of shares, the value of companies. The recovery over the course of the following year has been relatively strong. So broadly, they're back up to where they were this time last year. But often the level of risk that people will take is, again, quite a personal thing, and is something that only you will know what's right for you. So with a pension, again, a common way of getting your money invested is by giving it to a fund manager. And it's that manager's job to then choose the kinds of investments your money goes into. So you're not necessarily having to choose individual companies or gilts or bonds or whatever it might be. You're instead choosing a fund manager who will then manage the money in a certain way. And different fund managers specialize in different things. Some will specialize in buying shares of American companies or UK companies or big global companies. Others will take a mixed approach and invest into things like shares as well as bonds and all cash too. So trying to pick a fund manager who suits your own attitude to risk and your own aims is really important. And that's where Hargreaves Lansdown do a lot of research and offer a lot of information to try and help people in making those kinds of decisions. So there's about 3,000 different funds that are available and different fund managers. They will cover a whole range of different things. So if you're really interested in investing or investment themes, and there's something that particularly interests you or excites you, then chances are there'll be a fund whose fund manager buys companies that operate in that area. But from all those different funds, we've condensed who we feel to be the best funds and fund managers in the major sectors down into a list called the Wealth Shortlist. And these are funds that our research team think have the ability to outperform over long periods of time. And we're keeping a constant eye on these funds and fund managers, and there's a level of governance from us so that if we feel that they're not performing and you've chosen one of those funds, then you get notified. So there's always assistance from us on an ongoing basis. From that shortlist, we then condense it further down into ready-made portfolios, which will be based on the attitude to risk you feel that you're comfortable in taking, whether or not you're happy being adventurous or medium risk or conservative, somewhere a bit lower down the risk scale. And what our team have done here is, rather than giving you a load of funds, they suggest 5 or 6 different funds which might suit a certain type of investor. It is then just a framework for you to go off. So if you look at a portfolio and think you don't like the look of one fund or a couple of funds and want to add your own in, that's absolutely fine. It's not specific investment advice. It's really just giving you an idea of how we think a good portfolio can be constructed from the funds that we're particularly keen on. Alongside funds, it is also possible to use your SIP with Hargreaves Lansdown to invest in individual company shares. So if you want to buy listed investments on a recognised stock exchange, then you're able to do that. So there's a whole range of other investments for those people looking to be much more hands-on. So I mentioned the master portfolios. So this is just an example of what they look like. So you would select the level of risk you're happy in taking, enter the size of pension pot you've got built up, the lump sum, or the amount you're paying in monthly on an ongoing basis. And it then gives you an idea of the different fund managers and the funds that they operate. Whenever you see a fund highlighted in blue, if you click on that name of the fund, it will take you to the fund fact sheet so that you can find out a bit more about how the fund is run, why we like it, what they're investing into, and crucially, how they've performed over the last five years as well. On the right-hand side of the page, you can then see the suggested split, and this is where you can tailor it further to your own views. If you were particularly keen on an area or a sector and you wanted to invest more into that and less into something else, then you can just tailor that to your own views. And also having one eye on how you actually access your pension is really important too. Not all pension providers will offer a full range of services when it comes to retirement, and broadly speaking, when you do come to retirement, the different ways in which you access your money are via an annuity, which involves you transferring your pension pot to an insurance company who will then give you a guaranteed level of income for life and the ability to take up to 25% of the pot as a lump sum tax-free at the start. So the annuity then gives you that security, knowing that whatever the income is that's set up will then just pay to you for the rest of your life. You can elect to have the annuity paying to a spouse or a financial dependent as well. You can also build in things like inflation linking, so it increases each year in line with a measure of inflation. Often the more things you build in, the lower the income you'll receive to start with. But it's important to get it right for you, because once an annuity is set up, you can't then subsequently make changes to it. And if you have any medical conditions, then anything that might be seen to shorten your average life expectancy, the annuity company will actually pay you more to begin with, because they might assume that you're not going to be receiving the annuity payment for as long as average. So it's really important, if you decide to go down the annuity route, you really explore that very well. And Hargreaves Lansdown are one of the largest annuity brokers in the UK, so we can certainly assist with that. The other two methods, drawdown or uncrystallised fund pension lump sum, or UF plus withdrawal, are both something that Hargreaves Lansdown provide directly. Drawdown gives you the ability to keep your money invested, and you then withdraw an income from that. Again, at the point you enter into drawdown, you can take 25% of the pot tax-free as a lump sum. Anything further that you then withdraw is subject to income tax at your marginal rate. Where the money is still invested, it has the ability to grow over the long term, and ultimately you may get back more than you've put in. But also that is one of the risks with drawdown, that if your investment isn't growing in value each year and you then still want to take money out from it, your pot might diminish at a much quicker rate and you may run out of money before you pass away. The uncrystallised fund pension lump sum, it allows you to, rather than moving all the money into drawdown on a one-off basis, you can just take chunks out of the pot, and each time you do that, 25% is tax-free, the rest taxed as income. So both those methods are known as flexibly accessing your pot. At the point you do that, if you were to flexibly access your pot, the amount you can pay into the pension going forwards is capped at £4,000 each year. That's known as the money purchase annual allowance. So that's how your pension would work in retirement. If you decide to save outside of a pension, then there are other accounts which still give you the ability to hopefully benefit from rising stock markets over time and choosing your own investments. So with Hargreaves Lansdown, we operate a normal fund and share account, which gives you the ability to buy and sell investments with no particular tax advantages. There's a cash ISA, which gives you the chance to hold cash and receive a rate of interest, and on the interest, any cash held within a cash ISA, you don't pay any further taxes on the interest. And that's the same with a stocks and shares ISA. So investments within a stocks and shares ISA, if they grow in value, you're then exempt from having to pay any further taxes on those, be it capital gains tax or taxes on any dividends. There's also then a product known as Innovative Finance ISA. Hargreaves Lansdown operate a lifetime ISA, and there's also a product called Active Savings, which again is a way of getting cash invested and making sure that you're getting the best rate of interest possible on those cash savings. So the lifetime ISA is one which is a particularly interesting one. So it's available to anybody between the age of 18 and 39, and you can pay in up to £4,000 each tax year and receive an uplift from the government of 25% of whatever it is you pay in, up to £4,000. So if you paid the full £4,000, you get £1,000 from the government paid into the account. That money is then invested, so you can choose to again invest that and hopefully over time grow the investment. And when it's within the ISA, it's the investment growth is exempt from any capital gains tax in the future. That money can then be used for a range of different things. So if you're looking to purchase a first-time property, then you can withdraw the money and you don't have to pay any penalty on it. There's no tax charge to go back to the government. Alternatively, if you're not using it to save for a first-time property, the money can remain in there until the age of 60. And if it remains in there until the age of 60, then when you come to access it after 60, you don't pay, again, any penalty on it. If you decide to access the money before the age of 60, not to buy a first-time property, then you would pay a 25% penalty back to the government. So it does give you a bit of flexibility if you're thinking of putting money away for the future, but you're concerned about the ability to access it. But the ability to access it comes with the potential of having to pay a penalty back to the government. When you're weighing up whether or not a pension or a lifetime ISA might be better in your circumstances, the two, whilst they offer some similarities, there are some quite big differences as well. So the pension, any contributions into that, you get tax relief at your highest marginal rate. So if you're a high rate taxpayer, you get 40% tax relief, or an additional rate taxpayer, you get 45% tax relief. And you can pay quite a bit more into the pension. So subject to that annual allowance of £40,000 that we spoke about earlier. Both accounts have a wide range of investment options. When the money is in either the pension or the lifetime ISA, the investment is free from further taxes. The pension, the earliest you can access the money, is rising to currently 55, rising to 10 years before state pension age, so going up to 57 in 2028. With the lifetime ISA, again, as we just mentioned, you can either take the money out to buy a first-time property, or you keep it in there until the age of 60. With the pension, when you access it, whatever you come to take, 25% of it is tax-free, and the rest is then available as a taxable income via one of the options we discussed earlier. The lifetime ISA is after the age of 60, doesn't have any tax applied to it, so you can just take it out as and when you want it, and it's just a pot of money, so yours to withdraw whenever. But if you are taking it before the age of 60, not to buy the first time property, then you pay a 25% penalty. So having your account with Hargreaves Lansdown, all the accounts, so if you do decide to have multiple ways of saving through as a pension, lifetime ISA, fund and share account, whatever it might be, it's all operated through the one account. So you would log into the one system. You would then be able to see the various different accounts that you might have set up. It's all monitored as well through an app, which is free to download if you just look at HL in the App Store, and that will then give you the ability to see the pots of money that you're beginning to accumulate. And we have a help desk who can provide, again, much more assistance and guidance around your pension and around investments. They won't be able to provide advice, but it's really useful, especially if you're new to pensions or savings, and you are just looking to find out more information about how these kinds of accounts might help you. Do get in touch and ultimately have a look at the website as well, because there's loads of information on there which will help you make a decision. So I hope you found that presentation useful. I'll leave these important investment notes on the screen for a moment, and if you could just have a read through them, and then I'll put the contact details up again in a moment. Great. Thanks very much for listening, everybody. Again, I hope you found that useful. And if you do have any questions, feel free to send an email. Thanks very much. Bye.